Not knowing when to buy or sell, how to master timing your investments. Do you find yourself unsure of when to buy or sell an investment? You're not alone. In today's video, we're going to explore how you can make informed decisions on timing your investments and avoid the common mistakes that many beginners make. Investing can feel mysterious, even intimidating for beginners. One of the major hurdles most new investors face is knowing when to buy an asset and, just as importantly, when to sell it. The question of timing can seem overwhelming, and many overanalyze or worse, act impulsively. The good news is this: investment timing isn't about being perfect or predicting every market move. Instead, it's about understanding core principles, using smart strategies, and maintaining discipline. Whether you're someone who's just beginning or someone managing a portfolio and unsure of your next steps, this video is your guide to confidently timing your investments. Let's dive into the essentials of knowing when to buy or sell. Before we delve into specific techniques, let's understand what investment timing really means. Timing is about deciding the best moments to enter or exit the market to achieve your investing goals. It's not about perfectly predicting the top or bottom of a market swing, but rather making informed decisions to maximize gains or minimize losses over time. There are generally two main types of investors when it comes to timing: those who focus on short-term trends and those who take a long-term perspective. Short-term investors follow fast market movements, aiming to profit from quick buy and sell opportunities. While this strategy can bring fast returns, it's risky and requires constant monitoring. On the other hand, long-term investors focus on the bigger picture, building wealth over years, if not decades. They're less concerned about daily fluctuations and more focused on the overall growth of their investments. As a beginner, ask yourself, which type of investor do I want to be? For the majority of new investors, a long-term approach provides more consistency and fewer risks. Once you've determined your investing approach, it's time to consider a few foundational principles. First, define clear goals for your investments. Do you want to save for retirement? Build wealth for a future milestone, like buying a home? These goals will help guide your buy and sell decisions. Next, consider a powerful strategy called dollar cost averaging. This involves regularly investing a fixed amount of money in a specific asset, regardless of its price. Dollar cost averaging helps reduce the risk of timing mistakes, as it ensures you're buying during both market highs and lows. Over time, this strategy averages out the cost of your investment, leading to more balanced results. Additionally, familiarize yourself with market cycles, the natural rise and fall of markets over time. Knowing where the market currently stands within its cycle can help you understand whether it's a good time to buy or sell. For example, during a market downturn, assets are often undervalued, creating buying opportunities. Conversely, in a market upturn, overly high valuations may signal it's time to sell or hold. As you progress in your investment journey, reading market data becomes an essential skill. Don't worry, it's simpler than it sounds. Starting with a key indicator, the price-to-earnings (PE) ratio, can help you identify whether an asset is overvalued or undervalued. A low PE ratio may indicate a good buying opportunity, while a high PE ratio might suggest an asset is overpriced. But remember, numbers should be only one part of the decision-making process. You'll need to assess market trends and your personal goals as well. Recognizing trends is a useful timing strategy. For example, if an asset has consistently underperformed relative to the market but has strong fundamentals, it may bounce back, offering a good entry point. On the other hand, an asset showing rapid, unsustainable growth may indicate the market is overhyped. A common saying in investing is, buy low, sell high. While this approach makes sense in theory, it's tough to execute perfectly in practice. Instead of aiming for perfection, focus on recognizing approximate buying opportunities when an asset is undervalued and selling points when an asset looks too expensive. Investing is inherently tied to our emotions, fear and greed being the most prominent. Let's address two common emotional traps. The fear of missing out, FOMO. You're likely familiar with the buzz of trending stocks or cryptocurrencies making headlines. While it's tempting to join the crowd, remember that chasing popular investments often results in buying assets at peak prices right before they decline. Panic selling. During market downturns, your instinct might be to sell and cut your losses. However, rash decisions made out of fear often lock in losses instead of allowing your investments time to recover. The secret to managing emotions is patience. Historically, markets have recovered from almost every downturn, rewarding long-term investors for staying the course. Remind yourself that investing is a marathon, not a sprint. One of the most effective ways to master timing is to create and stick to a well-disciplined plan. Begin by determining how much risk you're willing to take. If you're risk-averse, focus on reliable blue-chip stocks or diversified funds. Another critical component of strategy is portfolio diversification, spreading your investments across different asset classes like stocks, bonds, and real estate to reduce the impact of any single asset's poor performance. Using dollar-cost averaging, as discussed earlier, can also help smooth out the market's volatility. It prevents emotional overreactions to short-term price movements and ensures you're continuously building your portfolio. Additionally, assess your portfolio's limits. It's okay to take profits when an asset has performed exceptionally well, especially if it represents an outsized part of your investments. However, avoid frequent trading, as fees and taxes can significantly cut into your returns. Fortunately, modern technology has made tracking investments more accessible than ever. Beginner-friendly apps can provide real-time data and insights to help identify trends and guide decisions. Learning to read simple charts such as candlestick or line charts is another great way to understand market movements visually. These charts highlight key price levels, making it easier to spot trends and reversals. Other valuable resources include educational blogs, books, and expert opinions available online. Remember, becoming a knowledgeable investor is a process. Absorb information gradually while applying what you learn through small, manageable investments. As a beginner, it's important to be aware of common pitfalls that many new investors encounter. One major mistake is timing the market instead of investing steadily over time. If you wait for the perfect moment to buy or sell, you might miss out on growth opportunities. Markets are unpredictable. What's more important is having a consistent strategy. Another mistake is chasing profits during market bubbles. While it can be exciting to hop on the latest investment trend, remember that inflated prices don't last forever. The crash that follows can be brutal. Lastly, inexperienced investors often act when they don't need to. Sometimes, the best course of action is simply to do nothing and let your portfolio grow naturally. Resist the urge to micromanage unless you're responding to significant shifts in your goals or market conditions. It takes time to feel confident in your investing skills, and that's okay. Start small. By experimenting with manageable investments, you'll allow yourself room for mistakes while learning lessons firsthand. Make a habit of reviewing your decisions, both good and bad. For every success, celebrate the fact that you made a thoughtful, informed choice. For every mistake, analyze what you could have done differently and use that insight to improve. Steady wins add up with time, not just in financial gains but in personal confidence. Growth as an investor is all about persistence, patience, and being okay with not knowing everything right away. Learning when to buy or sell investments isn't about achieving perfection. It's about understanding principles, maintaining consistency, and keeping your emotions in check. By focusing on long-term goals, utilizing strategies like dollar-cost averaging, and staying disciplined, you can avoid many pitfalls that trap inexperienced investors. Equip yourself with the tools and knowledge to interpret market patterns, but remember that success is built on patience and continuous learning. Your investment journey doesn't have to feel uncertain. With the steps outlined here, you'll be better prepared to make thoughtful decisions about timing, or in some cases, trusting your plan and doing nothing at all. With time and discipline, you'll develop the confidence to navigate the financial market intelligently. Mastering when to buy or sell takes practice, but with the right tools you can make informed decisions and minimize risk. If you found today's video helpful, be sure to like and subscribe for more in-depth investment strategies. Drop your comments below if you have any questions and I'll be happy to help. Until next time, keep learning and remember to invest wisely.